Good morning, everyone. Thank you for dialing into the Unique Manager Showcase online event today. Each session will last 30 to 45 minutes with a 10-minute break in between each manager slot. If you wish to ask any questions throughout the presentation, you may do so in the Q&A box at the bottom of your screen. Lastly, I hope you enjoy your day, and I'll now pass you along to our first manager, Unicorn Asset Management. Thank you.
Good morning, everyone. Hopefully you can all hear me. My name's Alistair Hinton from LGBR Capital. Really pleased to be here as part of this Unique Manager Showcase online event today with Unicorn Asset Management to get things going. We are going to spend the next 20 to 25 minutes looking at smaller companies, UK smaller companies, and why smaller companies are an area of excitement and ultimately above market growth and returns for investors with Unicorn Asset Management. I'm joined by Max Ormiston, Alex Game, Fraser McKersey from Unicorn on the line. We're going to go through these slides for around the next 20 minutes, looking at the smaller companies effect and why the team is so focused on this area of the market for long-term returns. And then there'll be a time afterwards for questions and answers. As was just mentioned, any questions that come up throughout the body of the call, do just put them into the Q&A box and we will come to them at the end. So enough from me. I'm going to hand over to Max and Alex. Hopefully you guys can be heard.
Good morning, Alistair.
That's great.
Morning, Alistair.
So guys, just to kick us off, a little bit of background on Unicorn Asset Management. Formed in 2000, around 1.2 billion under management today, invested across 10 funds, all of which are high conviction, all of which are bottom up, active managed funds, all of which have a bias towards small and mid-cap equities. So what we're hopefully looking at is why do Unicorn Asset Management feel small and mid-sized companies are the best long-term investment opportunity. I will hand over to you.
Morning all, thanks very much for your time today. We're passionate believers in the merits of investing in small caps over the long term. This chart on the right-hand side shows the long-term returns delivered by small caps relative to large. Perhaps this is one of the most important reasons why people do tend to focus on small caps as a area of the market to invest in. So this analysis is performed by two professors from London Business School, clearly shows the superior outperformance delivered by small caps over the long term. Financial physics makes it easier for smaller companies to grow at more attractive rates relative to large. Clearly, £100 of additional profit will represent a higher rate of percentage growth for a smaller business than it would do for a large. In addition, smaller companies tend to be more nimble and adaptive to changing economic conditions. Clearly, in the current environment, that's crucial, not just from an ability to cut costs quickly, but also to be able to tailor business models according to changing customer circumstances and to make quick capital allocation decisions to invest for growth when conditions improve and normalise. In addition, some of the other strengths we have identified in smaller company investment strategies include a greater level of transparency. This applies both to investors in terms of our ability to look at the business's underlying operating divisions, their financial performance, and to some extent their accounts as well, which tend to be less complex than a larger company, and that makes it we find easier to analyze and understand how the business operates. From a the management's perspective, we tend to believe that having a less complex business is easier for them to manage,
and they have a greater degree of operational oversight over their business units. Other areas we believe are strengths include the typically higher level of shareholder alignment with management and often founding family members who tend to make investment decisions for the long term with a focus for shareholders in mind. And we believe this is one of the key strengths of investing in smaller companies. And finally, it goes without saying, we believe it's important to have a good level of corporate access, and we have strong relationships with management teams, which enables us to really get under the bonnet of these companies twice a year and analyze them in more detail.
Now, this is a significantly under-researched area of the market. As you can see from the chart, the average number of analysts that are covering small caps is significantly lower than those that are covering large caps. This leads to an information gap around the company and ultimately leads to inefficiency in market pricing. Clearly, for stock pickers like ourselves, that can present some excellent opportunities to buy into some very high quality businesses which may be market leaders in the niche sectors that they operate in. And what the market is not really correctly reflecting their merits in terms of their current characteristics or their long-term potential. And clearly this dynamic is being exacerbated further by MiFID II, putting additional commercial pressures on the stockbrokers and investment banks in terms of whether they should cover some of the small caps or not. Now, this is a very broad opportunity set in terms of the proportion of small caps as a proportion of the UK market as a whole. It represents a very, very small percentage by value, only 5%. But when you look at the number of investment opportunities, there are nearly 1,400 companies to invest in here. And that's 4 times the number of large and mid caps available. So this is a very broad opportunity set, which we think it's worth investors targeting and looking at the opportunities available.
Moving on now to some analysis of funds across both the UK smaller company space and the UK all companies fund space. So as I'm sure you're aware, the all companies funds typically represents growth funds invested in larger companies. And as it says on the tin, smaller companies tend to have a lower market cap of the companies they invest in. So some analysis that we've found is that there's actually quite a significant disparity of the largest top 10 positions that each fund holds across both of these fund sectors. So you'll see, looking at the red bars, funds in the UK all companies sector have on average around 19% commonality across the largest positions in the fund. And that compares to a much lower average of just over 10% commonality for funds in the UK smaller companies sector. So this really flags the level of active management and greater opportunity for active management within the smaller companies space, with many more managers having a much greater diversity of holdings across their largest positions within the fund. So I think this is, as Alex mentioned on the previous slide, highlights the breadth of investable opportunities within the small cap space, as well as highlights to some extent the importance of manager selection when investing in UK smaller companies funds, given the variety of holdings that each fund could contain. Moving on now to sector differentiation. As you can imagine, there's again quite a significant degree of variation in terms of sector exposure between small caps and large caps. So on this slide, we've defined large caps as being stocks included within the FTSE 350 index as the orange bars, and small caps as the Numis Smaller Companies Index plus AIM Index as the dark blue bars. So a couple of points to highlight on this slide. I mean, immediately drawn to the far right. So technology is significantly a higher weight within the smaller company space, and we believe this is an attractive growth area for investors within the UK market, alongside other typically growth sectors, including financial services and media, which are also more highly represented within the smaller companies' exposure compared to their large cap peers. As you would imagine, the FTSE 350 index has a significant proportion of its exposure within the banks, home builders, household goods and healthcare sectors, and oil and gas, which tend to be some of the largest companies in the market, and to some extent are also some of the most mature and stable businesses, but in our mind also offer fewer or less potential for growth over the longer term. So moving on now to some of the risks and the mitigations that an investor should look for in the UK smaller company space. Turning first to risks, there are obviously a number of risks which are different when investing in smaller companies compared to larger companies. Goes without saying, there's the well-known smaller companies premium, which reflects the return, the greater return investors anticipate for taking the risk of investing in smaller companies. Principally, we've named a few here. These include liquidity. So smaller companies tend to be less liquid on markets and therefore have wider spreads, making them more costly to trade. In addition, there can be more pronounced share price volatility, which can also lead to greater costs and cost of time when trading. Within the company's space specifically, UK or smaller companies in general tend to have a higher cost of capital. This includes both a higher cost of debt due to higher interest rates, typically applied for loans on smaller companies compared to those which debt markets which large caps can access, as well as the higher cost of raising equity capital, both due to the less covered nature of equity markets by brokers and the higher fees that are attached to that. And I guess next, turning to business risk, it goes without saying smaller caps do have a higher failure rate and tend historically to have had more exposure to the economic cycle. So that really highlights the need to have a high level of stock selection in the area. And finally, again, turning to reporting risk, smaller companies tend to update the market less regularly than larger companies. So from some smaller companies, you may only hear once or twice a year from them, and their reports and accounts may be shorter in length and contain less information than is disclosed by companies, large caps and international businesses.
So we think investors need to be aware of these risks, but we do believe that these risks can be mitigated following a number of well-followed principles. So firstly, invest for the long term. So adopting a buy and hold strategy ultimately reduces turnover within the portfolio and also reduces the trading costs, which Max talked as talked around in terms of the issue of liquidity. Secondly, invest in quality businesses. Just because businesses may be smaller and slightly at an earlier stage in their development, it does not mean that they're necessarily blue sky. We see many opportunities to invest in established businesses who are market leaders in their given niches which they operate in. They're profitable, they're generating cash, which is crucial because it then allows them to reinvest that cash into the business to drive future growth. And also investing in experienced management teams. So these are teams who have delivered to expectations or beaten expectations consistently over a period of time. They know their business inside out, they know the sector inside out, and ultimately they're aligned with shareholders through good equity ownership in the business. And finally, investing in small caps does require a heightened level of due diligence. As a result of the less publicly available information, you do need to put in a significant amount of work to get to understand the business. Meeting the company management teams is crucial. Ultimately, these are the people that are driving the business forward, executing on the growth strategy. So it's really very important that you spend the time to meet the management, to go and see the company sites, and it all helps to improve your understanding of the underlying business and the dynamics of their sector from which they operate in. Now this chart shows the long-term relative valuations of small caps versus large as the red line, and also mid caps versus large as the blue line. So anything below the green 100 line represents a discount to large caps. So just focusing on the red line, this shows the PE ratio of FTSE small cap divided by the FTSE 100. Picking out a few key events over the last 10 years or so, you can see clearly the impact of the global financial crisis, so 2009, the sovereign debt crisis in 2011, various general elections, the G16 Brexit referendum vote, and most recently the COVID-19 2020 sell-off. So as you can see, during periods of extreme market volatility and stress, small caps do tend to be sold off more aggressively than the broader market. And as a result, you can see this discount between small cap and large caps widening quite significantly. Historically, and this is by no means trying to make a forecast, when this discount has widened to significant levels as we're currently seeing, this has represented quite a good buying opportunity into small caps, as they do tend to outperform on the market recovery.
So piecing together the areas that we've covered so far, what does that add up to? I guess from our perspective, as Alex mentioned at the beginning of the presentation, is our belief that investing in smaller companies will deliver superior returns over the longer term, notwithstanding the risks that we have just talked about. So to really try and sort of demonstrate that, we've just put this slide in here, which shows the sector returns and fund returns over a 10-year period. So you can see both that the UK smaller company sector as a whole has outperformed the equivalent peer group sectors in all companies and UK equity income sectors over a 10-year period, as has, from Unicorn's perspective, the funds which we all manage have outperformed over a 10-year period and delivered above average and market level returns, led by the UK Smaller Companies Fund over that 10-year period. So I think really that hopefully demonstrates that, at least on a historical basis, we've by investing in smaller companies, we've managed to deliver superior above average market level returns. So just moving on to the conclusion now. In terms of the presentation and investing in small caps as a whole, I think it's clear to us, and hopefully clear to you as investors, that we believe that investing in smaller companies provides a very strong opportunity to deliver long-term returns and growth for investors over a longer period, and we can deliver that through best through an active management strategy, given the broad the broad universe and the factors which we discussed, including low levels of analyst coverage, which we feel, given an active stock selection strategy, is the best approach to investing in this security and asset class.
Now, we talked through some of the risks earlier. We do feel as though these can be mitigated by following some strict guidelines. So 1, invest for the long term. 2, invest in quality established businesses. 3, invest in experienced and incentivized management teams. And 4, maximize that information advantage through extensive due diligence, regular company meetings, regular company site visits, all very important. We haven't really talked about it so far in the presentation, but COVID does present both risks and opportunities for small caps. From a risk perspective, clearly the access to capital could become more prominent during a period such as this. There's also likely to be a higher number of failures within the smaller company space relative to the large. But in terms of the opportunities, these businesses are very nimble. They can adapt to changing circumstances. They can cut costs quickly to better match demand, and ultimately, as small cap investors, periods like this do tend to throw up some really compelling valuation opportunities.
Thanks, Alex. We've had a few questions coming in whilst you guys have been going through the sort of body of the presentation, looking at that smaller company opportunity over time. Not all of them, I guess, are specifically to do with smaller companies. Some more sort of wider market updates. So what I'll try and do is pick out some of those that are more focused on the smaller companies side of things first, and then maybe we'll answer a few of those more wider market questions. Obviously, the COVID elephant in the room, which you guys have mentioned at the end. There's a couple of queries on that. So one was, you touched on owner management as being a significant strength in terms of what you guys are looking for. Somebody's asked, owner management and sort of board tenure can be seen as an ESG red flag. Do you take a different view, or is it case by case?
So happy to address that. I think on terms of owner management, as I said at the beginning, it's a really important criteria for us when analysing any investment, and particularly from that shareholder alignment perspective. As with any investment case, we look at this on a case-by-case basis, assessing the quality of management in our view, as well as their tenure. So there's a lot of box-ticking sort of exercises out there, which will flag, as your the question has done so, whether a management or a board remain fit for purpose after serving on the company for so long. I mean, it's our belief that on a case-by-case basis, you don't want to get rid of good management and good directors who have successfully managed that business for a number of years just to meet a corporate governance directive. Having said that, I think the best boards and the best management teams are aware of their capabilities and their effectiveness in managing that business. And we would expect them to act accordingly and have succession plans in place, and to gradually manage that process in terms of replacing themselves on a sustainable and steady basis. So in summary, you know, it's not a cut and dried approach, but we would certainly rather back strong and management teams who've demonstrated themselves over the years, rather than kicking one out the door just to meet the corporate governance directive.
Great, thanks for that. Another question, this one's probably most applicable, Alex, for yourself or Fraser. I know if Fraser is with us, which is about tech companies. When you were looking at which companies make up sort of large components of our indices, not many of the larger companies tend to be technology companies. Now, that's not necessarily the same. I guess this is the question. They're getting at is not the same as in other parts of the world. If you think about the US, they have some huge mega cap tech companies. Why don't you get more large cap tech in the UK?
I mean, I think we're very lucky in the UK in terms of having a junior market in AIM that provides a very attractive sort of breeding ground for smaller growing software businesses. It gives them an access to capital, puts them in front of some long-term patient shareholders. These businesses, we think some of the best around in terms of their technology offerings. Unfortunately, in the UK, we find that many of these high-quality tech businesses that are experiencing good levels of growth simply get snapped up by either trade buyers or PE buyers before they make it to the FTSE 100 or further up the market cap scale. So, we don't really think it's a function of our lack of expertise in the space. It's more of a function of the deep pockets of some of the trade buyers and PE buyers in the space that do tend to buy these companies before they reach that level of maturity. I think also, you often find many of the buyers are overseas, particularly US buyers. Clearly there's an FX impact there as well. So weakened sterling over in recent times has made it cheaper to buy some of these businesses when you're a US dollar buyer. So that also has an additional effect. And also the valuation multiples that are in the US compared to the UK. US tech businesses typically trade on significantly higher valuation multiples. So some of the high quality software and tech businesses in the UK really are seen as quite attractively valued for overseas buyers.
Thanks very much. We've got a few more questions. I'm aware we're sort of running out of time, so I'm just going to keep firing through these and we'll see how many we get through. Fraser and Simon, I know if you do want to jump in, I'll put this one to you, Fraser, and I'll put the next one to Simon. What sectors are looking the most attractive at the moment?
I mean, it's quite interesting. I think there's opportunities across the board at the moment. I think small and mid caps have done what they normally do in a sell-off, in that they sell off quicker. And so they feel the pain a bit more than large caps in the immediate sell-off. Then they also have the capacity to recover. So our challenge at the minute is identifying opportunities that have sold off, but are still fairly robust business models and have the kind of opportunity to recover at a faster rate than the broader market. In terms of sectors, that's pretty varied at the minute, to be honest. I mean, we do have our kind of core sector exclusions, which are the same across all the funds. So no oil and gas, no mining. But beyond that, we're generalists and we'll look anywhere for ideas. So for Alex and I in the Growth Fund, a couple of our recent additions have been in travel and leisure and in retail. Not necessarily areas you'd be immediately thinking you want to fall over yourself and get into at the moment, but actually the sell-off has created good opportunities in high quality names if you're able to take a long-term view. So it's very difficult to highlight, significant sector opportunities in this environment. I think they're across the board, and for stock pickers like ourselves, there's some great opportunities out there at the moment.
Thanks very much. Simon, this was a question on liquidity. As manager on both the income and smaller companies fund, how have you found liquidity this year so far in the volatility?
Liquidity's been pretty decent. It's probably worth pointing out that Unicorn, we've been investing in small companies for 20 years. We have certain hard limits on each of the funds that really put a cap on how much we can invest in any one company within a fund. That's 5% of a company's issued equity. So that helps us with the liquidity anyway. But you've seen a heightened level of liquidity within the market in certain areas. I mean, it's been varied day to day, but I don't think we felt severely hampered in any of the position changes we've wanted to make over the last 3 months.
Okay. Very simple. And another question, I suppose, on where we are at the moment. Where do you feel we are in the market cycle?
Me? Okay, that's a difficult one, and I don't think we've got quite enough time to answer it in full. But I'd say you've seen certain areas of the market recover from this. You've got sectors that Fraser sort of touched on already, the ones that represent great value, the ones that are recovering faster. So you expect to see anything with infrastructure exposure do well. Cyclicals are beginning to recover after taking significant share price hits over the last couple of months. But you are seeing some sort of, you've seen a bottoming off there, and you would expect to see those recover a little faster as well.
Thanks very much, Simon. I am aware that we've sort of hit the end of our half-an-hour slot, and I don't want to outstay our welcome. So look, I will say thanks very much to you all for joining us this morning, Alex, Max, Simon, and Fraser. Thanks for answering all those questions. We didn't manage to quite get through all the questions that were submitted, but we will come back to people offline and follow up with you all separately where we have not managed to speak to you. And if there's been anything that's come up that you would like to speak about or find out a little bit more on any of the funds or on the smaller companies investment side of things, do please get in touch with your contact at LGBR. Otherwise, thanks Unicorn for taking us through why you guys find smaller companies so compelling over the long term, and indeed how you have managed to outperform not only UK markets but the smaller companies element of that over the long term across the funds. It's very, very useful. So thank you all. Thank you everyone for joining us this morning for the first session at the Unique Manager Showcase. It's going to be a sort of short, break now with the next session at 9:40. I look forward to speaking to all of you again soon. Thank you.
Thanks everyone.
Thank you.
Thank you.